You look at the amount of gold that China's been accumulating, and we're only supposed to believe and producing that they have 26 or 2,700 metric tons. They have way more than that, and their banks are accumulating it and doing so in a manner that isn't reported to the IMF. Why would anyone tell the IMF exactly how much they have? And people have been saying China's been underreporting it forever. You know, you look at like ICBC Bank and a few of the other state-owned banks, they buy gold as a proxy on behalf of the PBOC. They work at the refineries all around the world. They don't tell this to the IMF. It's not reported. Everyone always said China underreports, China underreports. But now we're supposed to believe them, right? Alistair McLeod says, you know, that they have 40,000 metric tons or thereabouts, 5 times what we do, and of which the state owns 20 and the people own 19. But I look at like India as an example of what's really happening. They bought 1.5 times the amount of gold in the first 4 months than they did in the entire year last year, but they repatriated 100 metric tons from the Bank of England, which by proxy is the London Bullion Metals Exchange. And all of these countries in Africa, including Saudi Arabia and Egypt, have repatriated their gold from the New York Fed, i.e. the COMEX. So it's not only the accumulation by the most well-informed traders, it's also the repatriation, the removal of counterparty risk. And that's a lot, I think, what Zoltan Pozsar is talking about. That's why it's commodities. We've broken trust. And I think that's the most important thing. When the central banks say we're going to keep buying, sure, I would argue that the numbers that we all are led to believe are way underreported. The IMF says that. The analysts at Bank of Montreal says that. And everyone has said that about China in particular for years, going back as far as I can remember. So I would simply say that there is no reason for gold to have been reclassified tier 1. And when you see, other than that it's significant in terms of where it's going. And when I say gold, silver is part of gold. And as one goes, so too will the other ultimately, for different reasons now. But one's not going to the heavens without the other one coming with. But I think when you see the repatriation, it speaks volumes. It's about the loss of trust. This is what it's all about, the loss of trust. And can you put Humpty Dumpty back together? Don't know. The trust is something that I think is very difficult to get back once you break it in any form of life, whether it be relationships or in this case, the world reserve status or the center of free trade. People look at this country differently now in many ways. And I think, maybe the most important way is the risk of having assets in treasuries as savings. Instead, they're looking at commodities, which I think have no counterparty risk, and the relevance of how important they are. The central banks say that, and I would argue that they're buying way more than they're telling us and producing more than they're telling us. So, tell us just enough to keep us interested. But if we really knew how much the Chinese were buying or any of these countries, the price would go parabolic. And it's in all of their best interest during the accumulation phase to be tight-lipped about that and not be genuine. Doesn't do them any good to do that.
Gold accumulation, particularly by China, we're led to believe they have around 2,700 metric tons, but that's far from reality. China's true gold reserves are substantially higher, and they've mastered the art of keeping it off the radar, especially from the IMF. It's no secret that China's state-owned banks, like ICBC, buy gold by proxy for the People's Bank of China, working closely with global refineries. This activity is shrouded in secrecy, and it's been common knowledge that China underreports its gold reserves. Alistair McLeod suggests China might actually hold around 40,000 metric tons, with 20,000 owned by the state and another 19,000 by the people. This dwarfs the US reserves. But China isn't alone. Look at India. They've been on a gold buying spree, purchasing 1.5 times more gold in the first 4 months of this year than they did the entire last year. They've also repatriated 100 metric tons from the Bank of England, which is significant when considering the London bullion market. African nations, Saudi Arabia and Egypt, have also been repatriating gold from the New York Federal Reserve, reflecting a broader trend of reducing counterparty risk. This movement signifies a profound loss of trust in traditional financial systems. When central banks themselves are buyers, it's a clear signal. They're not disclosing their full hand. The numbers we're shown are just a fraction of the reality. Analysts from the IMF and the Bank of Montreal have echoed this sentiment for years. Gold's reclassification as a Tier 1 asset was a game changer, marking its importance in the global financial system. And silver, as gold's trusty sidekick, will inevitably follow suit. The repatriation trend is not just a logistical maneuver, it's a loud statement about the eroding trust in the current system. Once broken, trust is incredibly challenging to restore, whether in personal relationships or in global finance. The global reserve status of the dollar and the perception of the U.S. as a safe haven are now under scrutiny. We're witnessing a paradigm shift. Central banks and nations are pivoting towards commodities, which carry no counterparty risk. They offer stability in a world increasingly seen as fiscally unstable. The sheer volume of gold being bought and not disclosed points to a strategic accumulation phase. If the true extent of these purchases were known, gold prices would skyrocket, and that's not in the interest of the accumulating parties at this stage. Let's cut through the noise. Inflation, soft landings, trillion-dollar debts. Since 2020, the U.S. national debt has ballooned by over $11 trillion, and unfunded liabilities stand at a staggering $150 trillion. In just 6 years, 100% of tax revenue is projected to go towards mandatory entitlements and interest on the debt. Military spending, currently discretionary, might soon face funding challenges. This fiscal trajectory is unsustainable. The result? Gold and silver prices are set to soar, not necessarily because they're gaining intrinsic value, but because the dollar is losing its purchasing power. The de-dollarization trend is unmistakable. Countries are seeking alternatives to the dollar and U.S. treasuries, driven by inflation risks and geopolitical dynamics. Bretton Woods III is all about commodities, and this shift reflects a loss of confidence in the dollar and treasuries.
Everyone talks about the price of gold and silver and inflation and soft landing and all of the noise, but let's break it down and make it real simple. I mean, look, we're adding $1 trillion in debt every 100 days, and we have 150 trillion in unfunded liabilities. The national debt is up 11.5 trillion since 2020, and this is a country that has its fiscal house not in order. And when you look at the unfunded liabilities, who's going to pay for them? And when the Congressional Budget Office says in 6 years, 100% of tax revenue goes just to pay mandatory entitlement and interest on the debt only, when you realize military spending is discretional, who's gonna fund our military? So we have a situation that is it's not. We can't continue down this path, put it to you that way. And so I would just simply say that ultimately, gold and silver go higher in the face of a dollar that falls. And I don't know if it's gold and silver going higher as much as what JP Morgan is saying is that the dollar has to fall. And that's really what I think ultimately will happen. Now, when you look at what's happening around the globe, the de-dollarization, the de-treasurization, a growing union of countries, as we've talked about forever.
De-treasurization? Is that a new one?
De-treasurization, yes. Well, I mean, that's what they're doing. Why would anyone want to hold treasuries? You look at gold, it's up 9.9% on average for 25 years. That's doubled the pace of the 10-year treasury. And we've proven to the world that we don't like what you're doing. We'll take your treasuries and might even give them to the country or buy weapons with the proceeds and give to the country you're in a war with. That's a very tough thing to come back from. So I think ultimately it leads to more of the same. Countries seeking alternatives to the dollar, seeking alternatives to the treasury. Read Zoltan Pozsar. This is Bretton Woods III, all about commodities. And it's also a country that has obligations that will be very difficult to meet just from tax revenue. So where are your options? Raise taxes, print money, and selling treasuries in an environment where there's only $8 trillion in treasury holdings that are foreign held. The majority of it is owed to us. Foreigners are not really keen. Now, there are some countries, if we are to believe that UK and Ireland and Cayman Islands are keen on holding our treasury debt, but the ones that have been responsible for funding our spending binge seem to be moving in another direction. So yeah, ultimately, I think those numbers might even prove to be low. Ultimately, gold and silver go higher in the face of obligations by this country that can really probably only be met through printing of money or monetization of bonds. Same thing, because just no one wants to hold our treasuries because of inflation risk, default risk, and outright confiscation risk. And I think that's really where it is in its simplest of terms. So yeah, I don't think we've seen anything yet, I guess, is the bottom line. And I'm happy with those numbers, but I would think that they could actually be much higher.
Well, then I will raise you a Bank of America. They're calling for 3,000 ants over the next 12 to 18 months. So does that fit your forecast a little better?
Yeah, I mean, it does. And I think that does. And then you take 3,000 and divide it by 42, which has been, the average price ratio of the last 100 plus years. You get $71.50. Divide it by 7 and you're almost to 400. That would be what it's coming out of the ground at.
Now, turning to the broader implications. The average annual return on gold has been nearly 10% over the past 25 years. Double that of the 10-year Treasury yield. This performance isn't just a fluke, it's a clear indicator of the underlying shift in trust and value. The global community is increasingly wary of holding U.S. Treasuries, given the inflation risk, default risk, and the specter of outright confiscation. We're in an era where countries are seeking tangible assets over paper promises. This is evident in the actions of nations like China, India, and several others. They're not just buying gold, they're repatriating it, minimizing their exposure to potential geopolitical and financial disruptions. The actions of these countries speak volumes about the current state of global trust in financial systems. Andy Schectman, the president of Miles Franklin, highlights the significant shift towards commodities. He emphasizes that central banks are buying more gold than they're disclosing, indicating a broader strategy to secure their financial futures. The real challenge is understanding the full extent of these purchases and the implications for global markets. According to a recent Bank of America report, gold is forecasted to hit $3,000 an ounce within the next 12 to 18 months. This projection aligns with the broader trend of countries moving away from the dollar and towards more stable, tangible assets. The gold-silver ratio, which has averaged around 42.1 over the past century, suggests that silver could also see significant gains, potentially reaching $712 per ounce if gold hits $3,000. Let's break this down further. The global financial landscape is shifting, and central banks are at the forefront of this change. Their actions reflect a deep-seated mistrust in traditional financial instruments and a move towards commodities that offer stability and security. This shift is not just about numbers. It's about the fundamental realignment of global financial strategies, gold and silver, historical context, and future implications. Throughout history, gold and silver have been considered stores of value, mediums of exchange, and hedges against economic uncertainty. During times of economic turmoil, investors flock to these metals as safe havens. The current trends in global finance are reminiscent of past eras where trust in paper currencies eroded, leading to a resurgence in the value of precious metals. In the 1970s, for example, the world witnessed significant inflation and economic instability. Gold prices soared as investors sought to protect their wealth. Today, similar dynamics are at play. The global economy faces unprecedented challenges, including high levels of debt, geopolitical tensions, and a potential shift in the global reserve currency system. These factors are driving the renewed interest in gold and silver. Moreover, the advent of digital currencies and blockchain technology has introduced new complexities into the financial system. While these innovations offer exciting possibilities, they also bring risks. As digital assets gain prominence, the importance of tangible, time-tested assets like gold and silver becomes even more pronounced. They provide a stable foundation in an increasingly digital and volatile financial landscape. Strategic moves by nations, the geopolitical chessboard. The actions of nations like China and India are not just economic, but also geopolitical. By accumulating and repatriating gold, these countries are positioning themselves strategically. Gold provides a form of financial independence and security that is immune to external pressures and sanctions. In a world where economic sanctions are frequently used as political tools, gold offers a way to mitigate these risks. For instance, Russia has been steadily increasing its gold reserves over the past decade. This move is part of a broader strategy to reduce dependence on the US dollar and insulate its economy from potential sanctions. Similarly, countries in the Middle East and Africa are following suit, recognizing the strategic advantages of holding gold. These trends reflect a broader shift towards a multipolar world, where economic power is more evenly distributed among various regions. As countries diversify their reserves and seek alternatives to the dollar, the global financial system is undergoing a profound transformation. This shift will have far-reaching implications for international trade, investment, and economic stability. For investors, these trends offer both opportunities and challenges. On the one hand, the rising demand for gold and silver presents an opportunity for substantial returns. On the other hand, the shifting geopolitical landscape and economic uncertainties require careful navigation and strategic planning. In conclusion, the value of gold and silver is not just about their market prices. It's about the underlying trust and stability they represent in an increasingly uncertain financial world. As nations move away from the dollar and towards commodities, the true value of these precious metals will become more apparent. It's a time for reflection and reassessment, for individuals and nations alike. For Americans and their allies, the key takeaway is trust. Trust in our financial systems, trust in our government, and trust in the global community. The actions of nations accumulating and repatriating gold reflect a loss of this trust. It's essential to rebuild and restore this trust, not just through words, but through actions. Transparency, fiscal responsibility, and strategic foresight are crucial in this endeavor. As we navigate this shifting financial landscape, let's prioritize rebuilding the trust that underpins our economic stability and global standing. If you want to stay most up-to-date on the silver and gold markets, make sure to subscribe to my daily 5-minute silver and gold newsletter. It provides the latest expert insights, breaking news, market trends, and investment strategies, all in a concise format. Click the first link in the description to join thousands of others and enhance your investment knowledge right now. If you enjoyed this video, please give it a thumbs up and subscribe to my channel. Your support helps me stay motivated to bring more valuable content to you. See you in the next video.